Hello, everybody. Welcome to my continuation in financial statement analysis or financial statement ratios. This is part 5, other considerations, focusing on operating leases. My disclaimer and copyright notice: the information and opinions in this presentation are those of the author only and not the author's employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. This presentation is for educational purpose only. It does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2022 by Bennett Tchaikovsky. Note, the author does not claim any copyright whatsoever in any of the companies or organizations mentioned in this presentation. The other parties are the owners of their respective copyrights. So one of the reasons why I have to give this disclaimer is I am, in fact, a licensed California CPA and attorney. The other part is here, I do rely for this particular chapter or these doing ratios is heavily on Investopedia. It is a great free resource. I've had many students, they're not endorsing my content, but I've had many students who've said they learned more from Investopedia than they did in their classes. Okay, so we're going to cover 3 different topics in 3 separate videos, but the first one we're going to be covering is operating leases. So from a accounting perspective, if I sign a lease, if I'm going to rent office space for the next 10 years, prior to 2016, this was simply a footnote disclosure. I would just disclose this on my financial statements. Now, what happened is especially with airlines, there was this test. Is it an operating lease or is it something called a capital lease? A capital lease would actually go on the financial statements. What you had would be is that companies would prefer to have operating leases, because if you had an operating lease, it would just be a footnote disclosure. However, in 2016, they decided to basically gross up all of, and I'll explain what that is momentarily, but they decided to require you, even if it's an operating lease, that you have to record the asset and the related liability on the financial statements. There's a few exceptions to that, but this is a topic just for make sure that you understand what this is about. So let's just go ahead and take a look. So my example for this is that if you have a landlord who owns a building that it purchased for cash for $1 million on December 31st, 2022, this is in the future. Tenant leases the building for 3 years. Lease payments require payments of $75,000 per year. What you're going to see happen is on the books for the companies is that the tenant basically, as of December 31st, 2022, they're going to have to go through and say, well, I have a leased asset or right to use asset for $225,000. This is current, non-current, and I'll have a related liability, current, non-current, for the same dollar amount. Now, this same asset that is being leased to a tenant simultaneously is being shown as an asset on the landlord's books. So the reason why I'm mentioning this is that if you kind of think about it, we're effectively grossing up our assets. Now, obviously, we are recording also a related liability, but this is kind of one of the downsides to the operating lease standards, at least in an aggregate, standard. Now, the ones that I do want to share with you and look at today are going to be Starbucks and McDonald's. So let's take a look at those particular publicly traded companies. So if we take a look at Starbucks, and again, why are the operating leases important? It's because if I'm borrowing money from a bank and the bank requires me to maintain a certain ratio, like if they say, well, you have to have a current ratio of 1 to 2 to 1 or something along those lines, or if they have you have to maintain a certain assets to liabilities, the challenge comes in is that if I'm looking at my financial statement, what I probably want to do is to have some sort of a clawback or some sort of a modification on those loan terms where the leases are not really counting towards that. So if I'm looking at this over here, and again, I'm hypothetically speaking this, but the impact of this on Starbucks financial statements is this operating lease right to use assets. So of their total assets of this 31 billion, 8.2 billion just represents an operating lease, meaning they've signed leases. This is they have obviously the right to use the space, but this is an obligation that they have to those landlords. It's 8.2 billion. If I look on the liability side, which is essentially the operating lease liability is 7.738 billion is my operating lease liability. And then you have the current portion of the operating lease liability. So when I sign those leases in the next year, Starbucks is going to have to make 1.25 billion of lease payments. And then their non-current or their long-term lease liability is going to be approximately 7.7 billion. So effectively what you're doing is you're putting this asset on the books, which is really just a question of, oh, I can, rent this space. And at the same time over here, you've got the liability being recorded as well. I bring this question up to you as the reader is like, well, if I really kind of think about it, should this just be, if I don't own it at the end of the day, if it's owned by a landlord, is this better shown as a footnote disclosure rather than putting it onto the actual balance sheet? So when you see this, is this an asset? Well, cash is an asset. I know that I've got 6.4 billion of cash. That's not really what is an asset. It gives us future economic benefit. When you get to the property, plant, and equipment, yeah, I could turn around and sell it. But with the operating lease right of use asset, I just have the right to use some space. So it's when you're considering the assets of a company, this is something you just really want to be mindful of in terms of as you're going through and doing your analysis. I would really kind of question, it has value, but again, I'm probably old school. I just have a hard time seeing it. I would never, ever prepare financial statements without including this because I wouldn't want to get my stuff kicked out by the SEC. I'm just asking you to really kind of sit down and question this as you're doing financial statement analysis. Is this something we should really be considering as an asset? And also down over here, is this something we should be considering as a liability? It is a liability. I'm not going to deny that, but it's really, I'm going through and I'm using the office space. It's again, it's one of those things that is just really for your question. And this is a pretty big impact. So lease right of use asset net, 13.5 billion for McDonald's, for MCD, 26% of total assets. And you also see this over here, the lease, long-term lease liability, short-term is probably buried in here or up here, but you've got, 12.9 billion. So again, it's something that, is this a true liability? That's again, another point of consideration. The creepiest thing, by the way, is about McDonald's. By the way, their French fries are awesome. I can't really eat those anymore, but they were awesome at the time. Probably a little bit too awesome. What's crazy about McDonald's, they have repurchased 67 billion of their own shares of stock. That's neither here nor there. But again, this is really the question I want you to be asking yourself, is this something that should really be put onto the balance sheet? Now, what I would advocate to you is, like, as you're doing a financial statement analysis, I would possibly just back it out entirely. I would just take out the asset and liability. That's what I'm going to have my students do this semester, because I just don't think it's really, when I sign a lease, I have the right to use space, but I have a harder time viewing that as being an asset. Okay. So again, my opinion, okay, we're not going to change the way really the purpose of this video is to really help you identify those items that are being recorded on financial statements that I would say, it's not that it's questionable because it's the rules, but it's really something that you have to consider possibly removing when you're going through and analyzing various different publicly traded companies. So, but again, the big takeaway on this for lease accounting is that if you're, going to be borrowing money, and I would really advocate for, and I remember being at a couple different conferences where they were discussing that, I would really show possibly modified financial statements, just so that, or I should say, sort of with certain things backed out, just so you're not violating any terms of covenants or the like. So I want to thank you for watching this video here today. If you have any questions, feel free to email me at 1812cpa@gmail.com. I do try to answer questions that are put down in the comments to my videos. And, hey, don't forget to like and subscribe. I'm almost at 1,000 subscribers. I am going to try to give something away. And I may be in contact with, hopefully, with Roger, Becker, Wiley, or Gleim, and try to basically do a special video for my subscribers and give away a part of the CPA review course. Be exciting. So anyways, thank you for joining me here today, and I look forward to seeing you on the next video. Have a great day.